Hey, good morning, everyone. Marty Mazzora here. It's the 29th of April, 2023. This is your weekly economic update. I'm just going to jump right into it today, folks. We'll look at our index as usual. Then I'm going to rattle through a whole bunch of data points. Want to focus on the consumer this morning. Don't really want to get into markets as soon as we're done with the macro work this weekend. Then we're going to jump into the equity market conditions index. So early next week, I'll have some very market-oriented commentary for you, probably on the written blog. If you missed yesterday's video, please go back in your email inbox or on the blog page and check that one out. I go into a couple, I think, real key areas that kind of reflect current conditions and the setup and so forth. As for the economy, our PWA index actually broke even on the week. It's still a negative 33, which is still very much below zero, which still very much denotes recessionary conditions in the economy. In terms of the inputs that I chose, remember there's 45 total in our index. Today, looks like I have maybe 10 or 12, but I'm going to go through them pretty quickly. I mentioned the consumer. A lot of the data that we're interested in came out this week, starting with consumer spending or consumption expenditures. This is the line you want to look at. This is the month-over-month move, and it didn't move. So March spending essentially tied with the spending that we saw in February. In terms of personal income, it did rise a little bit, 0.3%. Month over month, still elevated, 5.9%, call it 6% on a year over year basis. Now, I want to spend a minute on consumer debt because, as we're out and about, I would think it'd be real tough to sympathize with our recession call for 2023. Or go out to dinner on a Friday night, go to the movies, book an airline ticket, book a cruise. People are out there enjoying themselves and they're spending money. No ifs, ands, or buts about it. Now, in the manufacturing space, you wouldn't know it's there because manufacturing, frankly, I think is still very much in recession. And that's how these things play out. Manufacturing first, services follow. But services is holding up a lot. And it just seems unusual relative to some of the negativity that we're seeing in much of the indicators. And if you agree with that, you definitely want to say to yourselves, well, $5 trillion was helicoptered onto the consumer, around the whole COVID experience. And getting that into and out of the economy is going to, I guess, distort things to some degree. Certainly normal cyclical patterns have been disrupted as can be. It should have been a doozy of a recession. Even without COVID, remember, our index went red in August of 2019 before we were aware of any pandemic. And I was actually anticipating a historically bad recession because of the state or the condition of the corporate debt market at the time. COVID actually provided the perfect excuse to bail out everybody and fix a situation that the Fed's own economists, as well as the World Bank and the IMF and every other, financial stress analysis you could imagine, was saying something really bad is going to happen during the next recession. The fact that COVID was the excuse gave political cover for an unprecedented and an unexpectable amount of stimulus to come in, and even the Fed doing something that the Federal Reserve Act didn't allow, and that was buying junk bonds. So when you have all that go on, and then we're already moving into what is going to be a structurally higher inflation regime anyway, then they just exacerbated that several-fold. And we never for a moment bought into the idea that the inflation was going to come and go almost in the blink of an eye. Yeah, absolutely, the bottlenecks, the locking everybody up and giving them $5 trillion, all that, it absolutely would have fueled inflation. But again, we were moving into a higher inflation regime to begin with. So it was our view that it was going to be pretty sticky, and it still is, as I'm going to show you here in a minute. But in terms of consumer debt, without going further off track, so what we have to think about as we go out there and say, okay, we're looking at everybody spending so much money. Is it just because they've still have a bunch of that stimulus money yet? Is it that they're making that much more money in their wages? Is this healthy spending? And when you look at consumer balance sheets, yeah, you could say they're not out over their skis, not even remotely like 2006. So absolutely, the consumer is in much better shape than he or she was heading into the last recession. And that's a good thing. And that may make for a historically mild recession, if indeed we have one. Nevertheless, we want to see how right now, real time, are they funding all of that spending? So the first graph, or the first panel up here, is just total consumer debt outstanding. And you can see that just is following just a pretty notable upward slope, right? You can see during recessions it tends to at least flatten out, right? But that's total, right? Here is the monthly change of total debt outstanding, and you see that's actually going down. So people are taking on a lesser degree of additional debt as the months go by, and you see how that tends to look heading into recession, right? So it looks like people are beginning to get a little bit conservative despite what you're seeing as you walk around out there. The year-over-year change, so total debt has gone up, but it's gone up at a slower pace here of late, 7.6%. Again, these are from high levels, but you see, as we roll over here, we have periods where we've rolled over and we haven't gotten recession, but one thing's consistent with recession is that it rolls over. And so now we want to get into the nitty-gritty of, what's going on out there as they're going out to dinner and booking vacations. Total revolving debt outstanding. Okay, so we see how the pace of total debt outstanding is slowing, but you can see that the pace of revolving debt, right, credit card type debt, is actually growing faster. That's what you probably don't want to see when you think about the strength of the consumer. This is the one that really has my attention. So this is credit card debt's contribution to total debt. Of all the debt that a consumer has, to what degree does credit card debt contribute to that, right? And that is just gone up almost parabolically, as you can see here. And look what it tends to do, right? Going into recessions. We don't have that data back that far, but before the Great Recession and before the COVID recession. But you can see revolving debt rising in here into recessions. And then you dovetail that in with the savings rate. And of course, remember, they got a ton of money, so they had this massive savings rate. They really couldn't get out and spend much. And then you saw it just absolutely plummet down to earth, actually to a pretty historically low level. Now that actually generally speaks good about economic activity while that's happening, because they're saving less and less. This is a savings ratio in terms of percent of income, but no doubt they were spending savings as well. And now people are really ramping back up their savings, right? 5.1% is not bad. Now you think, well, that's a good thing. Well, it's a good thing, but it also tends to be what this chart does, or what this graph does, right, during or just heading into recessions, right? Here you can see it moving up. This is people maybe beginning to worry a little bit about their conditions and needing to start saving a higher amount of their income. And at the same time, when we look at everybody in the aggregate, also charging more for their needs or for their experiences, that's a combination there that tends to be consistent, as I just showed you, with what these things look like as we head into recessions. And again, you can find periods outside of recession, but this is what we're looking at right here. And that's a pretty big bounce off the bottom. So that says something about consumer sentiment right here, I think. And then speaking of consumer sentiment, we track the University of Michigan's, this green one, consumer survey, and then the conference boards. The conference boards came out this last week, and I want to read from economist Peter Bookvar's summary of that report. The April Conference Board's Consumer Confidence Index fell to 101.3 from 104, and there was no change expected. So economists expected it to stay the same, and it actually went down. A 6-point drop in the expectations component was the main culprit, especially the employment figure, as the present situation was actually up 2 points month on month. 1-year inflation expectations were up 6.2, versus 6.3 in March and 6.2 in February. It was, though, 7.5% a year ago, but that relatively high inflation expectation is a big deal to the Fed. And remember, the Fed meets next week for their monetary policy session, and it's widely expected and discounted that we're going to get a 25 basis point hike in the Fed funds rate, and quantitative tightening, meaning the rolling off of $94 billion a month of their balance sheet. That's not going anywhere. What the markets are going to be intently focused on is the outlook and what they hint that they might be doing going forward. There was some slight improvement in the answers to the labor market questions, but after a drop last month. Of note, though, and dragging down the expectations component as stated, those expecting more jobs fell by 3 points to 12.5, the least since early 2016. Those expecting higher income actually fell 0.5 point, but that's after rising 1.8 points last month. Spending intentions weakened across the board with autos, homes, and major appliances. Bottom line, and this is from the Conference Board's analysis themselves, consumers became more pessimistic about the outlook for both business conditions and labor markets compared to last month. Fewer households expect business conditions to improve, and more expect worsening of conditions in the next 6 months. They also expect fewer jobs to be available over the short term. So according to the Conference Board's survey, consumer is beginning to feel it, and that's consistent with what I just showed you in the savings rate. Okay, now what also comes out with this data is the deflator, the PCE inflation index. And so that dropped to 4.1. Okay, so, and we talked about this way up here. It was easy for us to anticipate and forecast falling inflation from that peak because we had a slower economy thesis, and that, of course, inflation is going to come down. The question is, can they get it down, the Fed, to their 2% target, right, without creating one of these, right, without creating a recession? What was interesting, though, is the core rate, core inflation, 4.6 is essentially where it was last month. So when you take out food and energy, you're not getting that big decline that the Fed is hoping for. So think of this as we think about next week's Fed meeting. On the bright side, mortgage purchase applications actually ticked up a little bit here this last month. It is a tick up in this kind of condensed chart here. 4.6% was the improvement. You can see what the trend has been in mortgage applications. Also, borrowing from Peter Bookvar, some of the housing data that's not in our index. And by the way, we pick up, as you know, mortgage apps, housing permits, housing starts, the housing index, things like that. But we do definitely look at the rest of it. And last week, CoreLogic's home price index came out. It rose 2.1% year over year. That's the slowest pace since 2012. Not a bad thing, right? If we're worried about housing affordability. New home sales in March totaled 683,000, which was 50,000 more than expected, although February was revised down by 17,000 to 623. A jump in sales in the Northeast and the West led the way, with 9 months supply slipping from 7.6 to 8.4. The median home price was up 3.2% year over year. You can score those in the positive column. Now, last week's negative housing data that came out, pending home sales in March fell 5.2% month over month, worse than the forecast that expected it to actually be up 0.8%. Weakness was seen in all regions except down south. The NAR is blaming the limited inventory choices of existing homes, which is certainly the case with home builders gaining market share. Their chief economist said the lack of housing inventory is a major constraint to rising sales. Multiple offers are still occurring on about a third of all listings, and 28% of homes are selling above list price. Limited housing supply is simply not meeting demand nationally, according to Bankrate. The average 30-year mortgage rate averaged 6.97% in March. So that really flies in the face of our recession narrative. And again, like I said, things aren't going to shake out like you normally would expect when we had all this money ramping into the economy. On one end, I'm telling you that the consumers are getting more pessimistic, and on the other end, I'm telling you at least what's happened in March from a housing perspective. Now, if we're right about the balance of the year in terms of what the economy is going to do, I'll be reporting to you substantially weaker numbers in some of these metrics. And again, we're not wedded to that thesis. That's just how things look to us right now. But I certainly appreciate the strength in housing, and it's optimistic, and I'm hopeful that our recession indicator is wrong. But at the same time, one of the problems in the economy and all these distortions is that the powers that be are so desperate to keep recessions from ever happening. And if they desperately try to continue to circumvent them and mitigate them and soften them, a purging of all the excesses and the bloating that happened during long expansions doesn't get done. And then ultimately, the price to pay gets to be worse if we continue to just go to extreme and creative lengths to rescue the economy from normal cyclical factors. So, yeah, it's very interesting and unique because of the COVID experience, to put it mildly. Initial jobless claims actually improved. They came in better than expected. But again, as I've done over and over with you, regardless of the level we come off of, this kind of look is the kind of look that we tend to see heading into recessions. And continuing claims were also a little better, but again, the trajectory there is looking not so good, historically speaking. So capital expenditures, non-defense ex-aircraft, as you can see, it looks like it's topping out a bit. I'll zero in on that to give you a closer look here. And then shipments, you can see that looks like it's beginning to roll over after a nice long period of expansion. And you can see, we topped out here. We had a difficult period here. Our index came down a bit, never went into the red. This was a very difficult stretch for markets right in here, right in there as well. But we didn't have a recession. There was a lot of recession fears. I'm sure we were pointing to this at the time. Here we are before the 2008 experience. Before the tech bubble burst, we got a very strong signal right as we were getting into that. So now, it looks to be rolling over. If we just zero in on the last year, it looks more notable. You can see what's happened here. So definitely something to keep an eye on. And it would be something that is consistent with our overall thesis. Caterpillar global sales, we get this quarterly when they report. That's positive. It went up from 4% growth to 5% growth worldwide. Big decline in Asia. Of course, that you can blame on China and their lockdowns that persisted until recently. North America saw a big 15-point increase. So again, Caterpillar stuff is being sold. So obviously earth-moving projects are in the works. We expect a phenomenal amount of infrastructure spending to come globally, so that should bode well for Caterpillar. Latin America, which is actually a place that we're bullish on long term, saw actually a decline of 6%. Europe, Africa, and the Middle East actually saw an increase, so score that as a positive. The employment cost index comes out quarterly. Actually, wages and salaries grew 5.1% year over year. All in, employment cost index was 4.8. And again, so this is what, employers are paying to keep employees. And you can see that's a historically very high number. And yeah, that's inflationary almost by definition. Commodities, however, speaking of inflation, continue to roll over. And remember, I told you we cut some of our commodities-oriented exposure here recently and added things like healthcare and staples. Why? Because we're bearish on the economy short term, although long term we are bullish on commodities, particularly industrial commodities, but also in the kind of world we think we're going to have to deal with in the future. And that is one where I don't know how central banks, the U.S. in particular, get out of the mess they've gotten themselves into without negative real interest rates. And that means in the future, past this next recession, if there is one, allowing inflation to run hotter than interest rates like they did in the 1940s. And that's how they got the debt as a percent of GDP under control. I don't know that there's a way out of this one without ultimately doing that. It's called yield curve control, and we'll see how they couch it, but I think that's very likely in our future, and that is the ideal setup for things like gold and silver, gold in particular. So we didn't cut our gold exposure back. Yeah, so we'll keep that as long as we have this thesis going, and that's been a good position for us, a very good position for us actually on a year-to-date basis. The Baltic Dry Index, bulk goods across the world's oceans, you can see it fell out of bed right here. This is actually a positive sign about the global economy, right? A lot of factors, you know, ship availability, lots of things play into this. But, you know, we take it for what it's worth. You can see how it looks rolling into recession. You know, this right here is probably contrary to our recession thesis. It speaks to some optimism and some global activity picking up. This tends to go way up when China is doing a lot of infrastructure spending as well. But all that said, it also speaks to inflationary pressures, right? So anyway, so we'll keep our eye on that and everything else. And I'll leave it there. Thank you, folks, as always, for watching and listening. Have a great rest of the weekend. Talk to you soon. Bye-bye.